screen is visible to you?
I can hear you. I can see your presentation.
All right.
I don't see anybody saying no in chat.
All right. So this is the sequel of last lecture that we started about uh, African economic outlook. Now we already have an idea about investment outlook. Today we are going to talk about some investment opportunities that are relevant in Africa. So it's very interesting thing to know about. Now, I'm just giving you a brief idea that whatever we are going to talk about today is based on a certain report. What is the purpose of the report and a general overview that what is going to happen. So this report is being published by United Nations Development Program, UNDP. The title is basically UNDP African Investment Insights and Opportunities with reference to climate change. And it basically emphasized on climate related investment opportunities, how private sector can boost African economies, and nationally determined contribution under the Paris Agreement and other things. It used basically SDG investor maps, that is sustainable development goals, a market intelligence tool to help private investor that we are going to identify opportunities aligned with sustainable development goals. And but one of the most interesting thing about this report is it identified 207 investment opportunities. Although we will talk about the most important one from these 207 investment opportunities with significant financial and SDG impact. And that is across 11 sectors of economy, 24 subsectors, and 42 industries. So that is very comprehensive. You see, like a lot of industries, subsectors, sectors, and then they have identified 207 investment opportunities. So that is really an interesting to know about that what is going to happen in that report. So let's start with key investment data and trend. Overall investment, SDGs investment. So if we divide in regional distribution of investment opportunities areas, that is IOs, so Eastern Africa have 45%, Southern have 22%, and Western Africa have 21% investment opportunities, according to if we distribute the whole African region in these three different segments. And one of the interesting thing in terms of industries or sectors, the most prominent sectors for investment opportunities are basically food and beverages that represent 29% investment opportunities. There is like that much scope is available. Infrastructure at number 2 with 23% investment opportunities, and then healthcare got 11%. So these are the three important prominent sectors through which people can consider for investment opportunities. So regional and sector wise. Now we can see in that graph that a lot of things are there. The highest potential got food and beverages sector, then infrastructure, then healthcare, then renewable energy, education, consumer goods services, and financials. But the most prominent are, as we have discussed, the food and beverages, infrastructure, and healthcare. Overall, SDGs, we are talking about key investment trends. The most prominent industries, now moving towards industries, sectors, region, and now industries. Agriculture products, in terms of agriculture industry products, that got 18% potential of growth. Solar technology and project developers, 9%, and followed by the waste management of 6%. So these are the three major prominent industries that have the key investment opportunities and SDG investment opportunities linked with sustainable development goals. And indicative returns profiles, like in terms of, we already know that whenever we are comparing financial aspects or financial returns, so we are interested in internal rate of return or return on investments. I hope you people are clear about these two terminologies. I'm just giving you an idea that if you invest and how much you are getting in terms of your return, that is return on investment. And internal rate of return, the cost of your financing, and in terms of costing, how much you are getting. So that are internal rate of return and return on investment. So the key in returns profile, these are the two indicators that shows the most opportunity concentrate around 15 to 20%. Let's say 25% of have estimated IRR or ROI between 15 to 20% investment opportunities. Then 26% have IRR between 20 to 25. And for gross profit margin, again, these are all the financial indicators through which we measure the return of investment. So GP margin, gross profit margin, that is the difference between the cost and the sales price. 50% expect above 25% gross profit margin. So as a whole, the mean value, the average value is basically 15 to 20% return on your investment. So if you are investing, let's say 100, you are getting 15 to 20% on your return. So they are very promising returns that we can have on investment. You can see the IRR and ROI profile, 15 to 20%, very well distribution across of, so most that is relied on the positive side rather than a negative side. So that shows the mean value is about 15 to 20%. The key investment data and trend in terms of investments, market size, 38% of these have market size below $50 million. 31% of market size between 100 to 1 billion. So average, they are larger firms, and only 20% have a market size above 1 million. This is about the key investment data across SDGs investments. So that usually the major portion is below 50%, $50 million. The market size is relatively low as compared to the 20% which have an above 1 billion market size. In terms of investment timeframes, nearly half, which is 46%, requires 5 to 10 years to generate positive cash flows. That this investment time frame is basically, we can simply say that in how much time you can get back your money, or in how much time you can achieve your break even, or in how much time you can get your positive cash flows that you generating, that you start generating profits and positive cash flows. So usually 50% of the time that require 5 to 10 years, the mostly like the average is 5 to 10 years, there it will take to generate positive cash flows. And 34% expect a short-term time frame, that 34% of the times you can get back your money or you can generate a positive cash flow in less than 5 years. And very minimal, which is 20%, indicate a long-term time frame that the cash flows or positive cash flows or profit generation will occur over 10 years. So again, if we talk about investment frames, if we talk about return on investment and ROI and internal rate of return, mostly we got some very promising results, promising outcome in terms of investments, right? So this 5 to 10 years in long-term projects, in investment context, it is not has been considered a very long time. It is usually the average time period that on, and the 50% of the overall the industries of overall investment we can generate in 5 to 10 years. This is the general distribution of market size. You can see 1 billion, 100 to 1 billion is about 34 to 35%. Then higher than 50, less than 50 million and above 1 billion is usually only 20%. And 50 to 100 million is about 10, 10%. Now, let's talk about vulnerabilities to climate change. Now, this is a very issue, the Paris Agreement and NDCs. The report highlights the importance of Paris Agreement, which requires country to reduce greenhouse gas emission and adapt to climate change impacts. So we already know the climate change issue is very affecting the all the different countries, in particular the African region. So African government have defined national climate pledge through their national determined contribution NDCs. So aiming to limit global temperature increase to 1.5% degree above pre-industry levels, adopt to climate change and secure financing for these efforts. So that is basically the Paris agreements and NDCs that the purpose is basically we want to limit the global temperature, right, which is increases 1.5% above pre-industry level, right? So there is a 1.5% increase when there was non-industrialization are very less coming as compared to today's industrial revolution and all these things that we see over the period of time, right? And the emphasis is basically to adapt climate change and secure financing to finance these climate change projects. So this is the core of climate change, that how African governments, they are basically looking keenly about this issue. Now, there are certain NDCs investment opportunities. Obviously, this is linked with climate change. NDCs are presented as significant investment opportunity. Now, these NDCs in key economic sectors, and the report assessed these in opportunities across 16 African SDGs investor made, showing how business can contribute to achieve NDCs and measure their impact, right? So 16 African SDGs investor maps is there across African countries. And how the progress and challenges in an NDC implementation will work since 2015. It's very interesting that nearly all African countries have developed and updated their NDCs. Now, this is very promising that how the African governments, they are basically looking, they are keen in doing all these issues, and they are tackling the climate change issues and challenges and expanding their scope and integrating cross-cutting issues. And African NDCs prioritize both mitigation, that is reducing greenhouse gas emission, and adoption. They are working on these two things, right? They are mitigating on one side the adverse effect, and they are adapting, reducing vulnerability to climate change impacts, water resources, resilient infrastructure. So they are the key areas where now African governments are working basically. And 79% have government coordination mechanism for NDCs. Now, this is very interesting that almost more than 50% governments have now working on these NDCs, and many integrating NDCs priorities into policies and laws. Obviously, we know that when a certain government level policies and they are converting into the hard and fast rules and regulation and laws, so it's very become easy for the governments to achieve these issues, and they can tackle these issues, and implementation is obviously will be at high. So now there is that generated certain investment, climate change investment analysis. Certain opportunities are now arising since African government is working on SDGs. African government is working on CD SEDs, and so on. So out of 207 SDGs investment opportunities, 130, which represents 63%, contribute to climate action, and most focusing on adaptation, which is 47%, and mitigation and dual benefits are both like adoption and mitigation as well. And there is a strong alignment between SDGs investment opportunities and national climate pledges. Eastern Africa, in that context, has the most climate related opportunities, according to iOS 65 report, that within this whole region, the Eastern Africa has the most climate related opportunities, particularly adoption. While lower middle income countries and small islands, developing states, SIDs, show high climate relevance, right? So they are more like their adaptation in terms of climate change is more, and they are more inclined. And if they move to that very adoption, it is very climate relevance sort of thing. The most prominent sector, uh, like we are now going to the how this climate change investment is linked with sectors and industries. For the climate change, climate investment, food and beverage, infrastructure, obviously we know renewable resources and alternate energy is that is directly linked with climate investment. So these are the prominent sectors whenever we are talking about climate investment analysis, that these are the promising sectors through which you can invest. So food and beverages, infrastructure, and renewable resources and alternative energy. And most climate related investments have market values between $100 million and $1 billion, and often require 1 to 10 million in investment. So this is really an interesting that you need only 1 to 10 million dollars, and their market capitalization, their market value is 100 million and 1 billion. So that shows a very promising result in terms of how this uh, climate change investment attracts investment and how much they are paying. And one of the most important thing is that obviously whenever we are talking about investment, so we are interested in how much time and we can get back our money, and typically return time frame is only 5 to 10 years. So that is really interesting that if you invest in food and beverages, in infrastructure, in renewable resources and alternate in energy where 101 to 10 million dollars is required, you can get back your money in only 5 to 10 years, on average 7 years. And there are opportunities in mitigating tends to have higher potential annual growth rates and adoption opportunities, right? And so on. Now, next portion is basically based on area countries, the African Resilience Investment Accelerator that operates in Benin, Democratic Republic of Congo, Ethiopia, Liberia, and Syria. These are considered frontier markets in Africa. I'm just giving you an idea. You people are very aware about this, that what is the investment opportunities in these. So they are considered as frontier markets in Africa. Frontier markets, like we have different segments of the market. We have developed markets, highly developed, we already know. Then the emerging markets are developing markets, and then the frontier markets. Frontier markets mean they have a lot of potential to be shifted into emerging or developing or developed markets. So frontier markets play a very important role. Remember, whenever we are talking about investment opportunity, they always have a lot of investment opportunities. So these countries, these 5 countries, basically. And 5 countries, they are considered frontier markets in Africa. And basically, their focus is basically to mobilize capital for development, finance institution, DFIs, and local businesses. Now, from now onwards, we will move from public-private partnership that DFIs are working, the region is working, and the purpose is to mobilize capital and local businesses, right? So in that context, we will be referring to area, region, and DFIs, development finance institutions, right? So our next discussion will be based on these two institutions and this region as well. Now, the African area companies, there are certain companies in these area countries, the large multinationals and international companies. There are a lot of large multinational and international companies like they operate in multiple African countries, typically in mining, let's say the Barrick and Anglo Gold, in telecom sector, let's say MTN Orange, and transport and logistics sector. So these are the major sector who have a large multinational and international companies are working in these regions. DFI relevance. So basically, generally do not require DFI funding for the core operation due to strong financial capacity, but may seek DFI financing to local joint venture to spread risk and benefit from the association in with reputable international investors. So they are looking for different developmental financial institution for grabbing certain money and to make financing available to these different sectors. They have very strong organizational capacity and access to internal and external sources of financing. So this is the core. Obviously, we know that if we have a strong organizational capacity to access both internal and external sources of finance, you can finance these projects, you can finance these companies. So obviously, that is the main future of these companies, the large and multinational companies. Basically, in area classification, the regional rates, international companies with a regional focus, active in area credits and other financial markets, frontier market solution, Pan-African financial institution like Yuba, Access Bank, Box, Guaba. So these are the different frontier the international companies they are working with within this area region. Once again, they do not have the financial strength of local conglomerates, but are better positioned to raise capital than most local companies due to international management teams and access to investors. So they are not that much linked with the local financial institution and development financial institutions. Obviously, sector focus is their main key, and a relatively strong organizational capacity and capital need in the context of they have an access to international investors. Now, conglomerates like the group of different companies, the group of different. So typically, the most successful private owned and significant companies in their respective countries, well diversified operating across various sectors like Aja Group Holding, the Sethi brothers in Liberia. So they are basically the private owned most successful companies, major global conglomerates, right? There are a lot of private institutions. They are working collectively as in the form of conglomerates, and they are working in a private owned organizations. Obviously, they are attractive investment candidates due to the strong track record and likelihood of creating successful new businesses lines. So DFI relevance is very high. And the main sector is basically multi-sector activities. And they have very strong financial and analytical capacity as well. If we talk about the small companies, that how they perform, they often operate as a quasi artisanal and semi-informal businesses. And they are generating less than 1 million in revenues, usually $1 million. they have a lot of, they required small placements and many technical assistance. So their DFI relevance is very high, small companies. They are usually the small companies, often younger companies, sometimes semi-informal, limited financial and analytical capacity they have. So in these regions, these three frontier markets, these three sort of companies, the international, the large scale, the small scale, they have all these have different DFI relevance and different uh, formal and informal business operations. So this is the whole scenario. If you just look at to your screen, that local small companies, the mid-sized companies, local conglomerates, regional players, and large multinationals, and different examples and features. There are very few opportunities for local and small companies. There are very limited smaller opportunities for mid-sized companies. If we focus to these things, this we have already talked about. If you can follow my cursor, so you see the few opportunities are there in local and small companies. I'm talking about investment opportunities particularly. There are limited smaller opportunities, and the most opportunities, if we talk about, and if we check the regional players, and if we talk about local conglomerates, so these are the major sectors. If I just go through these names, like the examples of MB Para Business Group in Ethiopia, then Erivan Group in Benin, the Seti Brothers and Group in Liberia, the Box, Powergan, Baobab, Finca, Equity Bank. So if we, these are the just few examples that how these. Now, one thing is very important in that context. You see the local conglomerates and regional players. So they have, this region have got the most opportunities. These sector have got the most opportunities where we can invest. And obviously, the large multinational that already have limited large opportunities. They are limited, but obviously the large investment opportunities are always there. But in terms of most opportunities, investment opportunity, these two sectors are very, you see the promising sector across all the different sectors. There are different banks they are working. Since these banks are very important, because the banks offer majority of DFI, developmental financial institutions. So banks play a very important role in investment opportunities, since they finance to these financial, these different sector, different markets. And obviously in frontier markets, remember, banks play a very important role. Rather than the market-based, frontier markets are more mainly institutional-based rather than market. So major international and regional banks, they operate in multiple countries like EcoBank, Bank of Africa, Bora Bank, and Equity Bank. And local private banks like the form of Raw Bank in DRC, the Dashin Bank in Ethiopia, International Bank in Liberia, Union Trust Bank in Syria, and the state-owned banks like Commercial Banks of Ethiopia, the Liberia Bank for Development and Investments. So these are the banks. Now, why these banks are important? Basically, they are offering DFIs, majority of DFIs opportunities in these markets. You can see that how these different local, private, and government and foreign banks they invest over there. Foreign have large in Benin. Government have a very the green color is with government, and local and private in DRC and Ethiopia. Mostly the local private banks are investing more in terms of ownership, or they have more ownership categories over there. But mostly the foreign banks are the main source of banks' assets. Now, this is very important, this slide. If we focus on this slide for a minute or so, we can see there are 128 companies that area has identified are looking for a combined $2 billion in investment. So there are a lot of companies, and majority that we have talked about, the conglomerate and regional players, they got the measure, but 128 companies fell. So there are a lot of companies are available, investment opportunities are available. One thing. And the second thing is 45% of pipeline business are looking for debt financing only. So pipeline business is one of the most important sector that requires a lot of funding opportunity to kickstart their businesses. Now, moving to this part of the investment opportunities in the area pipeline, we see 27% are in agribusiness, 21% in financial institutions, 19% in manufacturing, and 17% is in energy. And let's 53% of projects require 5 million to $20 million investment. And 37% of the businesses of pipeline businesses are looking for combination of both debt and equity. So pipeline businesses, like the businesses, they are about to start, you see, they are they have the potential to invest. So you see like a lot of businesses, they need a kickstart, they need financing. And if there is a financing, 45% of the businesses, they are looking for debt financing only, and they can start. So there are a lot of DFI opportunities as well. Now, the different sectors of activity and investment needs. So total investment that is sorted to 128 companies identified by ARIA are looking for over 2 billion in investment. Now, this is very interesting that this region got 2 billion investment opportunities. And obviously, the key sectors for investment opportunities, agribusiness. 27% opportunity exists in forestry, agriculture, production, and so on. And then financial institution. On the basis of our previous slide, we can see the agribusiness and the financial institutions, which represent 22% investment opportunities in banking, particularly in private banks, mid-sized financial institutions, microfinance institutions, small and medium enterprises firms, SMEs and SMEDAs are working. So these are the major sectors of activity and investment needs. Further, the manufacturing sector, it got 19% investment opportunity. That include companies producing food, consumer products, construction material, textiles, and chemicals. Then energy, 18%. Services, services in the form of education, health, and retail, 5%. Infrastructure, 5%. Disruptive technologies, 3%. And extractives, only 2%. Now, what is the impact in terms of potential? That if this region tracks 9 major impact themes across investment opportunity, natively owned businesses. Most impact opportunities involve supporting the development of locally owned companies. Obviously, we know that localization, and if you empower your local businesses, local owned businesses, so native owned business have got 42% investment opportunities, followed by import substitution, followed by export focused, climate change for 24%, and large employer only got 24%. That shows the public-private partnership, natively owned businesses. That is the key potential and impactful investment opportunity. So this is all about the sector and investment needs. Agribusiness 27%, financial institution got 22% investment opportunities, manufacturing 19, energy 18, and so on. So measure three, if we list down 3 to 4, they are agribusiness, financial institution, manufacturing sector, and energy sector. So just these, if we are looking for an investment in all any of these sectors, obviously a lot of future opportunities are there and a lot of good returns we can make. Again, rural businesses are again impactful potential, 22%. Let's say agriculture and agri processing. That also includes banks, microfinance, institution reaching rural areas. Then the food security. This is one of the major problem that most of the nations and particularly the African nations are facing. We have talked about in our previous class that what are the different issues, financial and economic issues. The food security was one of them. 20% potential is there. That generally includes local champions in agri processing, retail expanding, food production, and availability. Then the energy access, 19% got potential. It usually involves large utility scale projects to increase electricity and female led businesses. 17%. There are very few opportunities, reflecting a wider trend and suggesting a need for gender focused approaches and capacity building. So, obviously, the gap is there, the opportunity is there, and if we can fill that capacity building and we can focus on gender focused approaches, then this 17% may be covered as well. That now moving to this sector of activity and investment needs, you see 42% of the companies are natively owned. If we talk about the 100%, and 9 major impact themes are rate by area and major themes that we have already discussed, and 50% project have significant impact substitution or export potential. Now, these two things are very, very much important. The local natively owned companies, and then the export potential of these companies that have a significant potential of 50% exporting as well. Now, if we talk about transformational impact, project that can significantly improve the business operating environment or transform a country's economic structure. Let's say, if we talk about that, how we can transform impact, usually the infrastructure projects, especially in an energy sector, reducing production cost and increasing productivity. Obviously, we see that a lot of new factor of production methods, technique, operation management, like supply chain management. So they're all involved, engineering processes, right? They're all involved in reducing production cost and increasing productivity. Then the telecom and internet providers, they are expanding connectivity, logistics, let's say the GLS logistics in Liberia, and financial sector projects, increasing access to finance in underserved sectors like agriculture. So this is how the overall economy of the business may be transformed if we can invest in infrastructure projects, the telecom sector, and financial sector. So these are the 3 major impactful sectors. They can transform the whole economic structure of the country as well. Now, what is the investment readiness and technical assistance that is required? Investment readiness gaps, like 43% of pipeline companies are not investor ready and required technical assistance. Now, this is the lot of the issue. 43% of the businesses, they are ready to start, but these companies are not investor ready. Investors are not investing, right? Investment readiness gaps is there. Businesses are there, companies are there, but the required investment is missing. One thing. Secondly, the documentation gaps are there. So I will talk about that, how these issues can be reduced. 54% have significant gaps in required documentation, like business plans, investment memos, financial models. And the second thing is local companies are often unfamiliar with these DFI requirements, that what is required for to get the loan. I'm not saying exactly, but this is the financial literacy that is the measure that is causing the major documentation gap over there. And then the early stage, 38% or at too early a stage for DFI investment. Obviously, DFI is invest in those projects. They are basically running, they are getting some revenues. Obviously, financial institutions are investing. So the risk will be high. So 38% are at very early stage that DFI may make an investment in that project. And the other aspect, the financial performance, 18% have issues with financial performance. 18% of the companies. So obviously, if the company have financial performance issue, they are suffering losses in other way, we can say, obviously they will have an documentation gap. They may have DFI requirement. They are not meeting DFI requirements. They don't getting the sufficient investments from either from market, from investor, from financial institution, from DFIs, from banks. No one is learning. And environmental and social concerns. Now, 5% have environmental and social concerns for the larger companies. And know your customer issues, that only 4%, that's is very minimal. That's the good sign that companies, they know their customers to invest accordingly. Now, what is the potential for tailored investment instruments? DeFis are developing innovative blended finance solutions to address all the challenges that we have discussed in the previous slide. The blended finance guarantees. Obviously, financial guarantees, we already know this is a very core or best thing for DFIs to lend or to invest in risky projects. So now they are blending the finance guarantees, providing risk coverage for equity and loan exposure. Let's say the World Bank Group's IDA private sector window, that is particularly for riskier markets. And early stage equity investment. We have talked about in the last slide how much 38%. You can see there early stage companies are 38%. So how this issue is resolved? Can help high potential projects develop a robust capital base and initiate transformative projects in manufacturing, energy, agri-processing, model like Infraco and Electrify provide funding and expertise to attract large stage debt funding. So all the businesses, they have very early stage in terms of their financing, but they have a very potential of these projects in future, or their long-term future earning capacity is basically the key issue. So that's why the early stage equity investment, they can, if they move to high potential projects, they can easily get access to this investment as well. And then tailoring investment structure. Many impactful projects have relatively small investment tickets, like 1 million to 2 million. Below most DFIs threshold is basically 5 to 10 million. And some DFIs are developing new approaches for smaller projects. So this is how we can lower the ticket size. I'm talking about the debt size basically, right? And then local currency products. The World Bank Group's local currency facility, that LFC, provide long-term local currency to IFC investments in IDA countries. And despite this, most DFI loans are in foreign currency due to financial policies and market challenges. But obviously, the V2 program is exploring unhedged foreign currency investment. So the opportunities are there, the local credit guarantees, they are focused in on frontier markets. So they are basically working on these things. Now, this is the six potential for investment instruments tailored to need for the local companies: blended finance, early stage equity, tailoring investment, and local currency investment. So if we conclude our all discussion about investment opportunities, so companies in areas frontier market broadly fall into five categories: local conglomerates and regional players offering the most common and relevant investment opportunities. I have highlighted this in the one of the table that these. So I repeat again, the local conglomerates and regional players, they are basically the most common and relevant investment opportunities. Secondly, investment are largely concentrated in the agriculture, financial, and infrastructure, and they got potential for significant impact in promoting local entrepreneurship, energy access, rural development, and food security. So, agriculture, financial, and infrastructure sectors. These are the three sectors that got the highest potential. And then DFI, for the DFI, it needs a flexible approach, including lowering ticket size, local currency products, advisory uh, support for complex transactions, the awareness about how to DFI, how to get via DFIs, and effectively match the needs of these businesses and foster positive impact. So that is all about